Are things beginning to crack? Just a little bit. Live from New York City this morning. Good morning, good morning. Equity futures just a little softer. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, coming up, global economic optimism beginning to crack as Chinese stocks wipe out gains for 2023 and debt ceiling talks are going nowhere fast. We begin with the big issue. Everybody needs to relax, apparently. Senate Republican leader Mitch McConnell saying, quote, regardless of what may be said about the talks, the president and the speaker will reach an agreement. As Congressman Chip Roy of Texas called default warnings a manufactured crisis, Republican House Majority Leader Steve Scalise is questioning how they even came up with the X date in the first place.
We'd like to see more transparency on how they come to that date, but Janet Yellen herself actually left the door open to delaying that in her tweets yesterday. The comments that she sent out yesterday implied that it's June 1st or later, giving some openness to the idea that June 1st may not be the so-called X date. So, haven't really been able to see a lot of transparency, but it looks like they're hedging now and opening up the door to move that date back.
Republicans then are doing their best to play it cool, as analysts at Goldman pencil in early June as a potential danger zone, and Morgan Stanley say June 8th is its base case for when Treasury runs out of cash. So what's left to address? Speaker McCarthy telling reporters that Democrats, quote, still want to spend more money this year than they did last year. He says that's a red line. Hakeem Jeffries, the top Democrat in the House, telling reporters that a freeze of 23 spending levels could well be a reasonable compromise. Joining us now to discuss is Bloomberg's Anne-Marie. Kelly Lyons down in Washington, D.C. AMH, where's the president on this?
Well, the president at the moment does not have any debt negotiations officially scheduled for the day, but his team does. And what we've learned, and this is one positive development, Jonathan, from where they left off yesterday. When they left yesterday, there was no plan to meet today. We do know this morning that the negotiators from the White House and the Republicans will meet today. McCarthy's also talking about that. So it's another day of big high-drama debt talks on Capitol Hill. The issue remains we are 8 days away from when Secretary of the Treasury Janet Yellen said could be the start of a potential default. She's calling this a hard line, even though a lot of Republicans are taking aim at that, and they think there's a little bit more wiggle room.
Well, let's build on that. Katie, Speaker McCarthy is saying, don't worry, we'll get it done in time. But apparently we don't know what time it needs to get done by.
Yeah, exactly. And we've been hearing this on the Republican side for some time now. Senator Mike Rounds was suggesting to me that he didn't think June 1st was a hard date as early as a week ago. It's worth noting, though, that when you look at the text of the letter that Treasury Secretary Yellen sent out, she specifically says potentially as early as June 1st. So, yes, she did acknowledge that there is some murkiness in this timeline because it really is about the inflows to the Treasury, what receipts look like, and then what they have to pay. There is a great story out on the Bloomberg terminal that shows date by date from June 1st onward what the Treasury's obligations are and what money they expect to come in. So the math isn't perfect here. I think everyone acknowledges it. And those on the side of those negotiating in the House, specifically on the Republican side, are maybe hoping that does leave a little bit of wiggle room, considering this is a very tight timeline and just considering the number of days it would take for any deal, which has not yet formed, to actually move through Congress, get passed by both the House and Senate, and make it to the president's desk. It's a question of whether or not they could actually get it done by June 1. They may need more time.
Let's talk about a substance. Get away from the rhetoric. Anne-Marie, you talked to the president over the weekend in that news conference about spending. What are the red lines?
So the president said he agrees that they can cut spending, but the president says he also wants to see revenue raises. That was his direct answer when I said, listen, Speaker McCarthy says they cannot spend next year what they spent this year. They actually want to spend less. So this is one of the biggest issues they have on the top line spending figures. We heard from Hakeem Jeffries, the leader on the Democratic side in the House, and he's saying he thinks that 2023 should be where they're starting from. The president talked about this. Where's their base case they're starting from to cut this spending? Then next, Jonathan, the other big substantive discussion is around work requirements. The president made it very clear before he left for Japan, his red line is no work requirements for those that need access to health care. But Now what the discussions are really starting to coalesce around is work requirements for access to things like food help and food security. The president didn't draw a red line on this, but this is going to be very difficult for him to walk because he is going to get a ton of blowback from the progressives in his party if he caves on this.
Looking out for more headlines through the hour and through this morning. Anne-Marie, AMH, alongside Kelly Lyons. To the two of you, thank you. Joining us now is New Edge Wealth's Cameron Dawson, Brian Whitestein and Morgan Stanley. To the both of you, thanks for being with us. You heard the words there from Leader McConnell. He says relax. Cameron, any sign that anyone's panicking?
Well, certainly it looks like there is some sign of panic being priced into the T-bill market as you've seen the T-bills expiring around the X-date surge. But at the end of the day, we really just have to follow the Treasury General account. We know that it's been whittled down to a measly about $60 billion. So you can debate all you want how much time there is left, but we can watch in real time how much money there is left. And so we know that whether it's June 1st or June 8th, a deal has to get done in order to avoid nearing that zero lower bound on the TGA.
Brian, with that in mind, is there any risk outside of these so-called at-risk maturities?
Jonathan, I think the risk is that we move beyond the date and shut down the government, right? I think the real risk is here you stop writing checks, you stop money flowing. T-bills being cheap is fine, right? Life goes on. But I think if you push it too far, and we've seen it before, you get downgrades, you get real panic, you get real hits to GDP. I don't think we're there yet in the markets or in the rhetoric, but it's a risk.
You said the most contrarian trade may well be that treasuries don't rally on this mess. Is that your base case?
Yeah, I've been a big believer that we saw the highs for the year in rates. I'm starting to question that. I think when you look on the other side of this and you assume we're going to get some deal in the next few weeks, I think you can highlight how much debt there is and how little is being done about it. And then we went and priced in all those eases at a time where inflation seems sticky, growth actually seems sticky. We still have stimulus money out there. And so I think what would surprise people on the other side of this is that Treasury rates actually retest those highs from October, November. And so, yeah, I'm a little bit more worried that we're going to get new highs in interest rates again.
Brian, as you look across the curve, on what maturity specifically?
I think we've seen the local highs in twos. I mean, those 5% levels I think would be bought greedily, at least for now. So I worry more out the curve, right? You could wonder if it's risk premium, right? Do you really want a 10-year note at 3.30 where it was a few weeks ago, or should you be charged more for a government that doesn't know how to pay its debt all the time? And also, again, if inflation is sticky, 3.5% seems not as great as maybe it did if inflation was easily falling back to 2. So I would think the curve ends up a little bit steeper, and the 10-year maturities get hit the most.
Cameron, this is the number one question right now for so many people. We tried to talk about it earlier this week with Jared Woodard of Bank of America. Should I be investing for a world of 5% rates, 5% inflation, or a future of 3%, 2%?
Well, I think that eventually we will move down to the 3% level. Our base case is that you don't get back to the 2% pre-COVID level of inflation really anytime soon on a sustained basis, simply because of the disconnections and the imbalances you see in U.S. labor market, wage growth remaining elevated. But what's interesting is that the bond market is still pricing in with a great deal of confidence that the Fed will be successful in getting back to 2%. You can look at those five-year forward inflation expectations, and they really haven't moved up substantially despite this whole inflation episode. So that could be an area where there is a mispricing in the longer end of the curve, that if you see inflation stick around, and maybe it's not 5, but even closer to 3, that should push up the inflation portion of the interest rate and really get us into a world where interest rates are higher for longer.
Cameron, you wonder what that would mean for equity market leadership, which has been dominated by a handful of tech names on the S&P 500 so far year to date. You can just feel the itch here right now of people wanting to buy this equity market and wanting to buy cyclicals and any relief off the back of debt ceiling talks, etc. Stuart Kaiser of Citi wrote about this yesterday evening. He said the story is that the Fed will pause, money will move into stocks, and underweight and/or defensive positions will be pressured to the upside. A FOMO trade will fuel a breakout and rotation trade. What's your advice right now, Cameron, to people who missed this move year to date and want to allocate fresh capital to equities?
Patience. I think that we've also seen, it's interesting, Citi came out this morning and showed that there was $21 billion of inflows into equities last week, and that's one of the highest levels in recent years on a weekly basis. So we already saw the FOMO trade in action as we pushed up towards that 4,200 level. But if you take a step back and move beyond positioning, which can move markets in the short term, what you look at is an equity market that is trading near the high end of prior valuation ranges pre-COVID, which means you've already priced in a lot of liquidity support, a lot of potential Fed easing into current valuations. And then on the earnings front, you have a big rebound already priced in to earnings in 2023 and in 24. So you really don't have any sign of recession in current earnings forecasts, which just means that it's a high bar for markets to jump over, really to get past sustainably that 42 or 4,300 level. So we think that in the near term, you likely get a better price in order to get access to this market. And we really do prefer things like equal weight indices, which don't have stretch valuations trading at just about 15.5 times if you really want to get exposure to the market today.
Savita Subramaniam of Bank of America talked about the same thing. Wants to allocate to the equal weight S&P 500, strip out the muscle of big tech. Brian, on the credit risk side of things, what's the potential for a risk rally, a relief risk rally off the back of some of this?
You know, there's not a huge sign of it in the fixed income markets. What you're seeing in credit is actually a very interesting trade, a bifurcation between the better credits in any sector and the worst. So if you look at high yield, the CCC part of the market's done really badly, right? There's a lot of dispersion of weaker companies trading high double digits or mid, and better companies trading well. So I don't think you're going to see a flight toward, to the bad stuff. I think you'll see a flight to the front end of people locking in yield. But I agree with what was said a moment ago. I think, the 5% T-bill, you don't have as much FOMO. So yeah, I wish I had all my money in stocks that went up 3x this year, but that's generally not how it works. But if you're earning 5% instead of 0, you have staying power. And this is a hard part of the cycle. You have to be patient, and you have to believe. If you believe this is the beginning of a new upswing, by all means, you should own risk. But that's not what the bond market's telling us.
Hey, Brian, you're not alone. I think we all wish we just sat there in two names, NVIDIA and Meta, and did nothing else. Brian Weinstein, Cameron Dawson, going to be sticking with us. Just getting a headline now that House Speaker Kevin McCarthy is speaking to reporters at the moment on debt limit talks. Any headlines from that, I'll bring them to you. The only piece of information I have for you right now is that McCarthy said he spoke to White House negotiators earlier on today. So that exchange did happen. They are engaging in talks, and we expect more of the same through today. Going into the opening bell, about 20 minutes out from the opening bell, from the cash open, equities are just a little bit softer. Let's get you some movers. Here's Abby.
And interestingly enough, John, we are heading into the worst 2 days in about 3 weeks. But nonetheless, let's start out with some gainers on the day. Coal's absolutely soaring. This as the company put up a surprise profit of 13 cents in adjusted earnings versus an estimated loss of 43 cents. The new CEO, Tom Kingsbury, is focused on fixing bloated inventories. Importantly, gross margins came in around 39% versus the estimate of about 37%. So things turning around there, perhaps. Amazon off of its highs, but up 0.4%. Mizuho naming it a top pick on its AI boost to the cloud. Speaking of AI, NVIDIA, AI all around it. This Bionic stock, John, into today up 110%, taking some chips off the table ahead of earnings tonight. Will it prove that perfection that it's priced to? Tesla also down 1.7%. A Chinese Tesla rival has forecasted a plunge in car deliveries, perhaps putting some pressure on its competitor, Tesla.
Abby, thank you. Much more from Abigail around the opening bell. Coming up on this program, as Chinese equities wipe out gains for the year and copper hits a new low for 2023, some aren't ready to throw the towel in just yet.
The last 4 or 5 months, people have been so underinvested, lack of conviction, they just still need to put some money to work. So it's nothing fundamental.
A conversation up next. Is the enthusiasm for the global economy beginning to buckle? Last week, there was this warning from JP Morgan's Mislav Matejka. The activity upswing seen around the turn of the year, which was helped by the falling gas prices in Europe and by China reopening, is unlikely to transition into an acceleration in the second half. This morning, China's benchmark stock index wiping out all of the gains for 2023 and copper making a new low for the year, breaking below 8K. Even Europe's luxury players have hit a bit of an air pocket. Today, worries about China. Yesterday, attendees at a luxury conference in Paris organised by Morgan Stanley flagging worries about performance in the United States. Bloomberg's Mike McKee joins us now for more. Morning, Mike.
Morning, John. It's an ongoing worry, but it's basically based around inflation. And we did have the Reserve Bank of New Zealand today signaling it's ready to pause. They think they have done enough to get inflation down, and they're a bit worried about the consumer as well. Here's what they had to say. The committee is confident with interest rates remaining at a restrictive level for some time, consumer price inflation will return to within its target range of 1 to 3% per annum. Now, we do see signs of consumers cracking around the world. If you look at retail sales in China and retail sales in Europe, China's the orange one there, and you can see after they came out of lockups, there were big jumps higher in spending, but they came out of this lockup and the jump isn't as high, and it has started to come back down. Meanwhile, retail sales have been tepid in Europe. They're barely moving, and they have fallen as well. Why? Well, it seems to come down to inflation and the shift in consumer preferences. Take a look at what happened in the UK in April. Their inflation rose on a core basis much more than anybody anticipated, but you can see it was all services spending. Goods spending actually saw some deflation. And so that's the problem for central banks everywhere, is that we have shifted our spending away from retail sales, away from goods to services, and that doesn't show yet any type of slippage. So while we're watching people like the European luxury retailers see sales drop, we're still seeing strong sales elsewhere that are pushing up on inflation and keeping most central banks still active.
Mike McKee, thank you, sir. Cameron Dawson, I wanted to come straight to you on all of this. Are you seeing signs of the enthusiasm for the global economy, China, Europe, is starting to crack?
When we see the untouchable, kind of imperceptible names get hit with big volatility alerts, it usually is a sign of a sea change. We had this unbridled optimism going into the year about Europe being better, global growth being better, China being better, really lifting European stocks. And now to see them react so sharply shows that people were probably pricing in too rosy of a future. Then when you start layering in things like copper, they call it Dr. Copper for a reason. And really it's a sign of global growth and global demand for heavy industry, manufacturing type of things. And as that starts to break down further, that really is a sign that possibly the big leadership we saw of cyclical names coming out of the October low has started to fade. And what we've seen is that even though cyclical names are telling you that they're raising guidance and the market is still strong for what they're producing, stocks are reacting really poorly. And that's usually a sign that they've gone too far too fast, and you're in a period where estimates likely start to move lower, not higher.
This has been building now for a number of weeks, Brian. We've been following it on this program. Brian, if you look at the manufacturing data, dreadful. You might make the case for rate cuts. You look at the services data, pretty resilient. You make the case for a pause and maybe even another hike in certain places. Brian, I'm trying to work out, and it goes back to a question I asked earlier on this morning. Should I be investing based on a manufacturing data or based on a services data?
I think the answer is the services data until such time that the market cares about the other. I mean, it's a bigger part of the economy. It's where the inflation is. It's certainly where the spending is going. And I think if you're the Fed, the problem they have is every time they pause, and by the way, you throw in the occasional run out of bank and their balance sheet expands, the market eases, right? The equities go up, financial conditions get easier, and they're forced, I think, to hike again. They may be forced again in a couple of weeks here. So I think the service data is actually the more important data for now. It's stickier. It's going to keep the Fed on hold, even if a recession is coming, because to get that inflation down, they need to lower demand. And so they have to be tough here. Eventually, the other data will matter, but that's not today.
What's your best guess then, Brian? Next move, a cut or a hike?
I think it's another hike. Again, listen, I think what the Fed wants is to be done. I think it's pretty clear. Jay Powell said it. They've done a lot. They don't know where they're supposed to be. They don't know exactly where restrictive is, but they're closer than they were. But I think the market pricing in eases and equities making, certain equities making new highs puts pressure on them to hike rates. So I think they want to stay. The market is going to force them to see if they will hike again.
Cameron, would you say the same thing?
Yes, we do think that it is a hike and not a cut. And even a pause, this market is seeing pauses as effectively a gateway drug to cuts. And that's not what this Fed wants. They're pushing back very hard against the notion of cuts in the back half of the year, simply because it does have the potential to ease financial conditions and further exacerbate their inflation problem. And I think at the end of the day, data in certain pockets of this market is starting to reaccelerate. Look at housing data. Look at that services data. All of this points to a Fed that really does not have the room to dial back its hiking. And so we think that we'll continue to see upward pressure on the probability of a hike either in June or July. It's moved up rather significantly in just the last week alone. And we do think that it's a hike and not a cut that comes next.
This is why they're so reluctant to discuss a pause. They do not want conditions to ease again with inflation as high as it still is at the moment. Cameron, Brian, two of the best. Always appreciate it. Thank you. Going into the opening bell, about 8 minutes away on the S&P 500. Just to work through the price action briefly. Equity futures negative 0.5% on the S&P. Yields have been higher for 8 consecutive sessions. A bit lower this morning at the front end, sub 430 at about 428. Looking into the FX market, the euro against the dollar. The euro was weaker earlier on. The dollar was stronger. Got down to about 107.50 at the low, 107.48. We're back above that level to about 107.90, getting close to 108 and through it very briefly in the last 10, 20 minutes or so. The latest update on the debt ceiling debate, Kevin McCarthy, the House Speaker, speaking to reporters a little bit earlier this morning, saying that he did speak to White House debt limit negotiators and others, he said, whoever those others might be, a little bit earlier this morning. Those talks will continue through today, and we'll bring you some more headlines a little bit later from Anne-Marie and the team down in Washington, D.C. when we get them. Coming up on this programme, the morning calls, and later, stick with tech or rotate to cyclicals. Keith Lerner of Truist says there's little incentive to chase stocks here. We'll catch up with Keith in about 8 minutes. This is Bloomberg. Softer, negative this morning, about 5 minutes out from the opening bell. Equities down by 0.5% on the S&P. On the Nasdaq right now, negative by 0.7%. Yields have been climbing relentlessly for 8 straight sessions. We come back in just a bit. We're down 2 or 3 basis points on a 2-year, just sub 430 at the moment, 428.91. That's the price action. Let's get to some morning calls. First up, Exane downgrading Shopify to underperform, saying there's better opportunities elsewhere given the company's valuation. That stock negative 1.25%. Goldman downgrading Southwestern Energy to sell, $5 price target, warning of further downside due to the company's weakening balance sheet. We're negative there by 0.75%. And finally, Mizuho naming Amazon a top pick for the rest of the year, seeing strong potential for its cloud business given the addition of, guess what, AI services. Amazon just about unchanged in early trading. Coming up, Keith Lerner of Truist making a case for remaining underweight stocks. That conversation just around the corner. Your market open up next with equity futures near session lows. 25 seconds away from the opening bow this morning. Good morning. Let's get this trading session underway officially with futures negative at the moment by 0.5%, there and thereabouts. Moving to the downside on the Nasdaq, negative by 0.6% yesterday. Biggest one-day drop on the S&P 500 in about 3 weeks. There's the opening bell. Switch on the board and get to the bond market. Yields higher, up and away over the last week or so. They come back in this morning by about a single basis point on a 10-year, 368.43. The euro was showing some more weakness earlier this morning. Makes a little bit of a comeback. The euro against the dollar, euro dollar 107.86. We're positive here about 0.1%. The euro making a comeback, and crude up 2%. All this talk about OPEC Plus's next move. maybe flushing out some of those shorts. Maybe that's what's happening now. 74.33 on WTI at the moment. More broadly, about 25 seconds into the session, here's the equity market on the S&P 500. We are negative by 0.4%. One stock to watch at the open, Urban Outfitters. The retailer reporting better than expected Q1 results and delivering an upbeat outlook. The CEO saying, quote, "We currently see no signs of change in customer behavior, no indication that customers are shopping less frequently or trading down. We believe Q2 could look very similar to Q1. Abby has more. Hey, Abby.
Hey, John. And the stock is absolutely soaring, up about 19%. Its best day since August of 2020 on the results that they reported, but also that outlook, really in contrast to other retailers. Now, relative to the quarter that they just reported, a huge bottom line beat by 60%, 56 cents on $1.1 billion. That revenue was also a beat of 2.23%. The street is wildly bullish. We have Barclays upgrading shares to an overweight from an equal weight, raising their price target to $38, suggesting that there's more upside potential ahead. We also have Jefferies, Wells Fargo, Citi, BMO, other banks raising their price targets. And apparently the strength really has to do with the Anthropologie and the Free People offering. But again, best in class to some degree. Some of these analysts very, very bullish here. And also Barclays saying that the sales to inventory growth is positive, positions them for positive to accelerating trends in regular price selling. So it sounds like they are fashion right. They have items that folks are willing to buy without a discount. Again, this stock absolutely on fire, up 19%, John.
Wow, what a move, and really interesting. Abby, thanks for that. In retail, you can get just about anything you want right now. You're looking for a signal to confirm your price, whatever it says at the moment. You can basically say Foot Locker, things are terrible, or you can say Urban Outfitters, things are okay. For Kohl's, reporting a surprise first quarter profit thanks to recent efficiency measures. The CEO saying this: "We're making progress in each of our key priorities, enhancing our customer experience, simplifying our value strategies, managing inventory, and strengthening our balance sheet." Kelly Lines, so far so good.
Yeah, and the stock is showing it, John, up more than 14% here in the first few minutes of trading, heading for the best day since March of last year. Really, frankly, blew it out of the water when it comes to the bottom line. Analysts were braced for a loss per share of 40 cents, and instead what Kohl's was able to deliver was a profit of 13 cents. And there's other noteworthy positives in the report as well. Gross margin of 39% topped expectations. And importantly, inventories dropped 6%. So that shows some progress in working down some of that bloat. It's not to say that all of it was all rosy. You did have a bigger than expected drop in comparable sales, the fifth consecutive quarter of decline, which shows they still have some work to do in getting people in the door, but still a sign that some of those early efforts on efficiency are starting to pay off. One thing I would note, though, is that Kohl's did leave its outlook steady for the rest of the year, despite delivering this big beat in the first quarter. The company's CEO in the statement also noting that the macroeconomic environment remains challenging. Certainly, though, not challenging for the stock this morning. Those gains are just getting bigger as we go, John.
I'm seeing some big gains this morning, up 17% on that name. Katie, thank you for that. Here's another retailer seeing continued strength, VF Corp, the company topping Q4 earnings estimates thanks to momentum at its North Face brand and product launches at Vans. Simone Foxman has more. Hey, Simone.
Yeah, VF Corp, also the owner of Dickies, and a bit more mixed picture here. Modestly beating estimates, EPS coming in at 17 cents rather than the 14 cents that analysts had expected. Revenue also a little bit higher. Was successful at, as Kaylee was talking about, cutting some of the excess inventory that it had, supply chain improvements. But what bulls are really going to be most tied to is some of the performance that it saw out of North Face, particularly in China, where sales of North Face were up nearly 40% in the quarter. But there's not so great news, too, and we were hearing pretty sour mood about the consumer looking ahead to decline, single-digit declines in terms of revenue for the next quarter. Jury's still out as well whether it can turn that struggling Vans brand around. Shares lost more than 50% of its value in the past year. And just this morning, we saw half a dozen analysts across the street cut their price targets for this company.
Just about positive on the session so far. 5 minutes in, Simone. Thank you for that. Here's a name I want to talk about. I want to turn to the financials and talk about PacWest. The good news is we're talking about PacWest for the right reasons. Monday, the stock was up almost 20%. Tuesday, up almost 8%. This Wednesday morning, up 2.6%. Leading the regional banks higher yet again, running for a third consecutive session after agreeing to sell its Civic Financial Services unit to real estate lending firm Rock 360. Just more encouraging signs they're making steps forward every single day so far this week. That stock getting back up to about 750. Not great, but an improvement, that's for sure, on that name. Puck West up by almost 2% this morning. More broadly, we're down by 0.5% on the S&P 500. On the Nasdaq, we're down by about 0.4%, continuing to pull back from 9-month highs on the S&P, with strategists remaining divided over the next move. Morgan Stanley's Mike Wilson delivering a warning this week, starting the week saying this: there are many technical signals that conflict with the idea that this is the beginning of a new cyclical bull market, including poor breadth and broad cyclical underperformance. Bank of America's Savita Subramaniam pushing back.
Narrow breadth is not a precursor for doom and gloom. I think it's kind of a false negative. And then when you look at valuations right now, they look high, which is another reason nobody wants to buy stocks. But valuations generally look high when you're in an earnings recession, which we are in right now.
Keith Lerner of Truist joins us now. Keith, always great to catch up with you, sir. Is narrow breadth the so-called false negative?
Jonathan, great to be with you. So the way I look at breadth is you'd rather have a broader market. When you historically test this, often breadth does catch up to the market. But I think, our point of view is right now is that we have this leadership, and we all know the story on these top-heavy stocks, that you really want to see things broaden out. But the challenge we have, and I know there's this whole debate about the S&P 500 versus the equal weight. We're overweight the S&P 500. We do have a position in the equal weight, but it's much smaller, and we would stick more with the larger cap ones. The way to think about that, John, is if we have 4 or 5 stocks leading the market, you need things to kind of rotate into these other areas of the market like energy, financials, industrials. The challenge that we see is we still think the economy is going to slow down. So these other areas of the market are cheap, but the business cycle is working against them. And as we think about the overall market, we just think it's uncompelling at current levels relative to these relatively high macro risks that remain.
Keith, how frustrating is this market for you at the moment?
It is frustrating because if you look back over the last year, really, the bulls are frustrated, the bears are frustrated, and we've been more on defense. We're waiting for a time to move on offense, but we're being patient because we don't think investors today are adequately compensated for taking on undue risk. So the back and forth for over a year, it's tiring. People are ready to move, but the fundamentals don't support a big shift. So we're just being patient. We do think there will be opportunities this year, but right now, you just came off the 4,200 level. The overall market is trading pretty full as far as valuations. And then even the credit markets. I mean, it's remarkable how stable the credit markets have been. So they haven't provided much of an opportunity. So, again, frustrated but patient.
Keith, you can feel the edge. I hear people, they talk about it out loud, making that rotation to the cyclical part of the equity market. You alluded to it. Stuart Kaiser nailed it over at Citi yesterday evening. There's this story out there, and he writes the following. The story is that the Fed will pause, money will move back into equities, and underweight or defensive positions will be pressured to the upside. A FOMO trade will fuel a breakout and a rotation trade. Keith, if you've missed the rally this year and you hear people say things like that, what do you tell them?
Well, so one of the things that even in our view, and we over the last month, we laid out the bull versus bear case as far as where we are in this cycle. One of the more positive aspects, but this note has alluded to, is that position is relatively short. If you have a more decisive move above 4,200, you bring in technical buy-in. But John, even if we do see that, we still think the upside is likely capped maybe around 4,300 to 4,325. That's about 3% upside. And partly on how we get there is, let's just say earnings are bottoming this year, right, at this level. Again, we think there's more downside, but let's just say that earnings are bottoming, and next year earnings rise about 8 or 9%. You put an 18 multiple on that, which is also pretty generous, and you get to about 43.25. So is that those are optimistic assumptions. Is that enough to go risk on it? And to be fair, Jonathan, in an overall portfolio, we have equities just relative to those long-term targets we're below. And actually, right now, Jonathan, as there's a lot of discussion on equities, the 10-year Treasuries moved up to close to 370. We actually think that's becoming more attractive again, and why we are overweight bonds and also overweight cash right now.
So, Keith, any reason to believe the leadership story changes, given the threats to growth that you still see, given the fact that you're willing to take on some duration risk as well, based on what you just told me in the bond market? Any reason to believe that leadership of this equity market is going to change anytime soon?
I think you could see a short-term move. Don't forget, we have NVIDIA earnings coming after the bell. And a lot of these tech stocks on a short-term basis are pretty stretched. They're approaching the 2021 highs. If you look at Microsoft, Apple, and NVIDIA. So that would be a natural place for a pause. I just don't think that if we do see a short-term move to some of these other being up areas, I just don't think it's going to be that long. So it may be a mean reversion trade. But I will also say, as you look out more, 6 to 12 months, we think tech will continue to be leadership. If you look at the technology sector relative to the S&P 500, it just broke out of a 3-year range that it's been since after COVID. So we still think that's leadership in a slowing economy.
Where does that leave the cyclical story abroad, Keith? Because at the same time tech has ripped, there was all this enthusiasm to buy the luxury names in Europe, try and play the reopening theme in China. You seeing threats to that now?
Well, I think some of the, what you just saw there overnight on some of these luxury brands is kind of the short-term risk to tech since it's a bit extended. But I will also say, based on what you've discussed earlier in this program, you're seeing, copper come down, energy materials underperform. I think one of the things that's helped Europe out quite a bit is the European banks. If the economy, slows down and we're seeing that impulse from China start to slow down, we think that Europe is unlikely to remain leadership. And if you go into a slowing economy, normally the U.S. outperforms, so we would stick there.
That would mean a big shift in the dollar as well, even more so based on what we've already seen. Keith, thanks for this, mate. As always, Keith Lerner there of Truist on this market. Just looking at the FX market at the moment, the euro against the dollar rebounding, but fading again, 107.80 on that currency pair. LVMH still negative in trading over in Europe. Year to date, still higher, though, by about 20%. The luxury names took a bit of a hit. There was a conference yesterday in Paris hosted by Morgan Stanley, which indicated that perhaps some softening of demand over in the United States. And overnight, the difficulties with China, you all witnessed that, and the equity market wiping out the gains for 23. We had some renewed weakness again in the luxury players, LVMH, Hermes, etc. These big consensus positions that have been built up on the reopening of China, some enthusiasm around Europe, has been pushed through the FX market as well. We've seen that breakdown in the currency market too, with the euro just weakening, really close to 111 at the back end of April, 110.95, and all the way back down to about 107.50 this morning, 107.48. to be precise. The broader equity market at the moment, about 12 minutes into the session, really no drama here. We're down about 0.5% on the S&P. On the Nasdaq, we're down by 0.4%. Coming up, looking ahead to this one, Ron DeSantis, the governor of Florida, expected to launch his presidential campaign tonight.
We'll be interviewing Ron DeSantis, and he has quite an announcement to make.
That conversation up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Morgan Stanley chief global economist Seth Carpenter. That conversation at 2:30 p.m. Eastern, 7:30 p.m. in London. This is Bloomberg.
I'm not at this time planning to endorse any particular candidate, but I am interested in X/Twitter being somewhat of a public town square, and where more and more organizations host content and make announcements on Twitter.
Florida's Governor Ron DeSantis expected to make his White House bid official. Bloomberg learning the announcement is coming tonight in a Twitter Spaces live stream with Elon Musk. Let's get to team coverage. Bloomberg's Anne-Marie back with us in D.C. Mandeep Singh here in New York City. MH, what are we expecting a little bit later this afternoon?
Well, it's going to be a Twitter Space event with the governor, Ron DeSantis of Florida, announcing his presidential bid, Jonathan. This is now weeks and months of speculation about this individual getting into the race, and it's happening this evening. Alongside that, his team is also going to be releasing a video. And already we've heard from the Trump camp, speaking to Bloomberg News, that they say this is perfect for Ron DeSantis, already trying to bash him because they say he's weak in terms of retail politics, and this is a safe space for him where he doesn't have to take media questions. It does really underscore the fact that he's doing this on Twitter, the fact that he's doing this alongside a polarizing individual like Elon Musk. It really underscores that he wants to make culture wars a keystone of his presidential bid. So a lot of people are expecting, obviously he's going to announce, but a lot of people also want to tune in and hear what else he has to say. I do question whether or not potentially Elon Musk might make more of a splash than him this evening. He's kind of giving some of his leverage to, at times, an individual who could be quite spontaneous.
Well, you've got the message on the one hand, the platform on the other. So let's talk about the platform. Mandeep, there was a great article in Axios this morning that basically reads as follows, that Elon Musk has displaced Rupert Murdoch and Fox News as the king of conservative media in recent weeks. Just how important is this platform going to be in the next 18 months?
Well, I think it's a big win for Twitter as a platform, simply because it's setting a precedent, a presidential campaign being announced on Twitter Spaces. And I wouldn't be surprised, if other platforms like YouTube, Meta has talked about launching a Twitter-like platform. I think you're going to see more of this in terms of live streaming and Twitter Spaces kind of thing in terms of this presidential cycle.
Mandeep, do you imagine there's going to be a political bent to it, though? Will there be a political leaning of this particular platform to one side rather than the other?
I think the risk is more for the candidate than it is for the platform. I mean, the platform is out there. I think what the Twitter Space is going to prove is other candidates will try to do something similar, whether they pick YouTube or any other platform or Twitter. But the point being, like, this is something to reach out to the masses. It's real time. And when you layer in, all the analytics that comes with, using a platform like Twitter, it's quite powerful for any political candidate.
Anne-Marie, there's going to be a ton of excitement around this. We're all looking forward to hearing from the governor of Florida. Some people outside of Florida aren't that familiar with this man. Can you walk us through why this is such a big name for this campaign?
Well, I mean, Elon Musk was one of the original individuals who said that he thought Ron DeSantis is the best bet to beat Biden in 2024. And Elon Musk had previously said he thought that Trump was too old, could not be the chief executive officer, basically, of the United States. Now Elon Musk is saying he's decided he's not going to put his name behind anyone just yet. But everyone is excited, Jonathan, because for many in the Republican Party, they did think this could be the new leader of the GOP into 2024. And he is, at the moment, the biggest rival to the former president, who is, though, leading in the polls. The issue is he has had a rough couple of weeks. So I think that is why there is a lot of attention on this evening's event to see how the governor does.
Anne-Marie, just briefly on the polls, how relevant are those polls this far out from the actual election?
It's anyone's guess, right? But it does bring to mind we have more than a year to go. So, yes, the former president is leading in the polls. He's leading with huge margins against whether it's Ron DeSantis, Nikki Haley, Tim Scott. But, Jonathan, we have months to go. So I think a lot of people I talk to say, listen, wait and see. It is way too early. And, of course, you just mentioned it. Ron DeSantis, very well known in the political circles, very well known in Florida, but he doesn't have that national appeal yet. Potentially, he will start picking up steam and gaining in the polls after he launches this bid.
It certainly doesn't have the reach, at the moment at least, of the former president. AMH and Mandeep Singh, to the both of you, thank you. Looking ahead to that talk, speech, address, exchange, conversation, whatever you want to call it, 6 p.m. Eastern Time. Elon Musk, David Sachs, and the governor of Florida on Twitter Spaces. The broader market right now, about 21 minutes into the session, we are a little bit softer. We're down by 0.6% on the S&P. We were down yesterday for the biggest one-day drop in about 3 weeks. We add to it. We take out some more weight from the S&P and just chip away at a monster year-to-date rally on the Nasdaq. We're down by another 0.6%. Let's get you some sector price action. We can do that now with Abby. Hey, Abby.
Hey, John, it's interesting to note that the financial is weighing the most, down 1.1%. Only one member of that sector is higher right now. And it has a lot to do with just the regional banks giving back some of the gains that they saw with PacWest driving the way after selling that construction portfolio. Industrials, materials, real estate also lower. Energy is the one sector that's ever so slightly higher. So bearish sector composition here. On the year, let's take a look at the chips because we have the big report today after the bell. NVIDIA. Again, that stock, unbelievable, up more than 100% on the year. Big pressure onto whether or not they'll deliver. Advanced Analog Devices, trying to mix up a couple names there, weighing today, John, down 7.4% and negative quarter, the worst day for that stock since 2020.
Let's see if the numbers validate some of the gains. These days, you just have to come on a call and say AI as many times as you like, and all of a sudden the stock keeps on rallying. Coming up on the programme, the trading diary, tons still to come up. In the last hour, it's been refreshing. We've barely talked about the Fed. This afternoon, we'll be talking a lot about the Fed. Two-day losing streak on the S&P 500. We take more weight out of the S&P. We're down by 0.7% over the previous 2 days. Yesterday, today, collectively this morning, we're down about 1.8%. Yesterday, the biggest one-day drop in about 3 weeks. Yesterday on the Nasdaq was the biggest one-day drop of the month of May so far. Against this, in the bond market, switch on the board briefly, we'll look at treasuries together. The two-year yield has just been climbing relentlessly over the previous 8 consecutive sessions. We come back in just a bit, down by 3 basis points on a 2-year, just sub 430 at about 428 at the moment. On a 10-year, about 368 as the debt ceiling talks continue in Washington, D.C. I think there's a whole lot more going on in this market beyond just that. Look to China, look to Europe. That's the price action. Let's get to the trading diary. At the top of the hour, Secretary Yellen speaking at a panel from London, 10 a.m. Eastern time. Fed Governor Waller, he's one to watch. He speaks at 12 p.m. this afternoon. Been quite hawkish over the last few months. Let's see if that tone sticks going into the June meeting. We get the FOMC minutes at 2 p.m. Look out for that. We'll hear from the governor of Florida. Ron DeSantis expected to announce his presidential campaign in a Twitter Spaces live stream with Elon Musk at 6 p.m. We'll get jobless claims coming up on Thursday morning, tomorrow morning. Looking forward to that. And rounding out the week with US PCE inflation and the UMich sentiment survey on Friday. From New York City, that rounds out the morning for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.